Welcome to S&P's European loan market video overview, detailing leveraged finance trends and activity during February 2012. I'm Suchit Gupta, a member of S&P Capital IQ's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe before winding up with themes to watch for in March and early April 2012. Before we start, please know you can follow LCD on Twitter, Facebook, and join the more than 7,500 contacts in LCD's Leveraged Loan Group on LinkedIn. The links to follow LCD are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. The market got its legs back somewhat in February after a shaky start to the year. Risk was back on. The high-yield market recorded its seventh week of inflows into high-yield funds, according to data from JP Morgan. The secondary loan market finished the month up 50 bips at 95.64. High-yield bonds finished the month up 460 bips at 98.51. Leveraged loan issuance stood at 2.8 billion euros for the month, and high-yield bond issuance had a read of 6 billion euros for February 2012, which is the highest read since April 2011. The S&P European Leveraged Loan Index, the LE, had a positive return of 0.73% ex-currency for the month of February. The primary markets opened up for both loans and bonds. With the high-yield bond market open, a number of issuers did bond-for-loan takeouts. The secondary markets recorded a gain again for the second consecutive month. Default rates, however, ticked up higher and are expected to go up higher later this year as well. Focusing on the secondary loan market, this chart details the average price of LCD's European loan flow name composite, a measure of the 12 largest, most liquid loans consisting of 10 issuers since 2002. Loan investors who are flush with cash and not that much paper available to them in the primary markets bid up loans in the secondary markets. The flow names rose 50 bips to close the month at 95.64. This next chart details the average price of LCD's European high-yield flow name composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market gained 460 bips during the month to close the month at 98.6, the highest read since July 2011. This next chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise noted. Given the positive performance of loans in the secondary market, it's not surprising that the European loan market posted a positive return of 0.73 for February 2012, down from the 2.19% seen in January 2012. The total LE return for the first 2 months this year is a positive 3.34% versus 4.14% seen for the same period in 2011. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. The primary market was open for both high-yield bonds and leveraged loans in February 2012. With 7 weeks of inflows into high-yield funds, according to JP Morgan, investors were looking for new primary deals to park that cash. High-yield bond issuance in February stood at 6 billion euros, the highest read since April 2011. There were several large multi-tranche issuers in February, including Orange Switzerland, Schaeffler, and Securitas. There were also a few large bond-for-loan takeouts for issuers such as Ineos, Numaricable, and Central Parks. New issue leveraged loan volume for February 2012 was 2 billion euros, up from the 1.2 billion seen in January. This includes new LBOs such as Allcell, CPA Global, and Orange Switzerland. Though for Orange Switzerland, the high-yield demand was so strong that the institutional loan piece got pulled, while for CPA Global, the loan demand was so strong that the deal got flexed, with spreads being flexed down and the OID being reduced. The default rate by principal amount stands at 4.9% at the end of February, up from the 4.1% seen at the end of December 2011. Meanwhile, the default rate by issuer count is up to 4.6% at the end of February, up from the 3.4% seen at the end of December 2011. Themes to watch for. With the high-yield bond market opening up and bond-for-loan takeout starting again, the virtuous cycle has started yet again. With the markets opening up, banks are willing to underwrite, with the usual caveats, though credit standards are being loosened as pressure builds on meeting budgets. There's still great uncertainty regarding turmoil in the sovereign markets, though at this point in time, it's just a binary outcome. It's whether Greece defaults or not. Given the volatile and bleak macroeconomic conditions, default rates, however, are expected to move up higher than what they already are during the course of this year. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including US loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.